Good morning. Today we will discuss the topic of capital and revenue expenditure and receipts. Final accounts prepared at the end of the year consist of the profit and loss account or income statement and balance sheet. These final accounts are prepared from the trial balances. All the accounts appearing in the trial balances are to be taken either to trading and profit and loss account or balance sheet. All expenses and receipts of the revenue nature are taken in trading and profit and loss account, and all capital expenses and receipts of the capital nature are taken in the balance sheet. It is therefore necessary to know what is meant by the revenue expenses and capital expenses, and revenue receipts and capital receipts and their importance in the preparations of the final accounts. Thus, it is necessary to classify the items appearing in the trial balance between capital and revenue. This classification is relevant for the adherence to the concept of matching cost and revenue to the given period. Such classification is essential in the respects of the expenditures, receipts, profit, or losses. Firstly, we see here the what is meant by expenditure. Expenditure means incurring a liability or the disbursement of the cash or transfer of the property for the purpose of the obtaining goods, services, or assets. According to guidance note on the terms used the financial statements issued by the ICAI. Hence, expenditure need not involve corresponding outflow of the cash resources from the business. It also includes within the scope the outflow in the form of the increase of liabilities and transfer of property. An expenditure is decided capital or revenue depending upon the variety of the factors as given some contents. In this content, first is the recurring and expenditure. This is one of the most common tests to decide whether the expenditure is capital or revenue in the nature. Recurring refers the frequency within the transactions occur in the business. Recurring expenditure is one which occur the frequently, for the example payment of salary, rent, telephone charges, etc. A non-recurring expenses is one which is a nature infrequent, for the example purchase of machinery. A non-recurring expenses is always capital in the nature unless the materiality concept the emphasis in the importance of the recognizing it as a revenue expenditure. A non-recurring expenditure is also regarded as a revenue expenditure if it is the represent a cost which has been the due to the normal abnormal factor. Then second content is effect on the revenue of the earning capacity. An expenditure in the form of the repairs of an already existing the fixed assets which does not increase the efficiency of the assets is regarded as a revenue expenditure. Expenses which seek to the maintain revenue are incurred in the normal course of business. For example, expenses of the whitewash of the factory building are the revenue in nature. An expenditure in the nature of the revenue maintaining the activity regarded as the expenditure in nature of the revenue enhancing activity is a capital expenditure. Third content is benefit of an expenditure. Another test to decide the nature of the expenses is benefit of the expenditure. It is based on the accrual or the matching concept. An expenditure whose benefit expires in the accounting period itself is charged as a revenue. The expenditure whose benefit is received for more than the accounting period is called as the expenditure. We see here capital expenditure and income means receipts. Firstly, we see the capital expenditure. According to Kohler, the Definition of the capital expenditure. Capital expenditure is an expenditure intended to the benefit future period in the contrast to a revenue expenditure which benefits a current period and addition to the capital assets. The term is generally restricted to the expenditure that add fixed asset unit or that have the effect of the increasing the capacity, efficiency, lifespan or economy of the operations of an existing fixed asset. It results in the acquisition of the tangible assets or right in assets benefit for the long period. Capital expenditure is that expenditure the benefit of which is enjoyed or the consumed not in the 1 year only but over many years. It is the expenditure incurred with the result in the purchase or the acquisition of the assets and properties which may be used for the many years. The main purpose of incurring such expenditure is to income over a period of the years or increase the earning capacity of the business concern with the aid of the such expenditure. For examples, purchase of plant and machinery, land and building, etc. These assets are used over a period of years. Such capital expenditure is shown in the balance sheet. Capital expenditure is one which is incurred on the some purpose. Uh, First purpose is the purchase of assets for the business for earning profits with their use, but goods purchased for the resale on the consumption is not capital expenditure but revenue expenditure. Then second purpose, expenditure incurred for the purpose of the putting into the working condition and assets bought. Third purpose, expenditure incurred for the putting a new assets to use. Next purpose means the expenditure incurred on the extension to or improvement in assets to produce more to improve the revenue earning capacity. Expenditure incurred on the assets and increase in the revenue earning capacity of its that's called the improving the production of income or increasing the life of the assets. Expenditure incurred in the raising capital required for the earning profits. Expenditure incurred for the acquiring the right to carry business. Then we see the test of the capital expenditure. The amount spent is generally large but not necessarily. The purpose is improve the enhance business to the productive earning capacity. The benefit of the expenditure is not executed in 1 year but it is available for the longer period. It is of the enduring nature. The nature of such expenditure is not recurring. That's called it is not occur regularly. Result in the acquisition of the assets or put the assets in usable condition. Amount is a return of the treated as a revenue by the way of providing depreciation or the amortizing over the useful life of the such expenditure. It is shown in the balance sheet as an asset till it is written off. Then we see the example of the capital expenditure. First is the purchase of fixed assets. In this concept, purchase price, import duties, initial delivery and handling cost, installation cost, professional fees for the architects, interest on loan taken for the purchase of machinery till the date of installation, administration overheads relating to the acquisition of fixed assets are consisting in the purchase of the fixed assets. Then second example means the expenditure during the construction. Then expenditure that improve the standard of the performance of the existing assets means expenditure which is extend the useful life of the asset expenditure with the expands of the capacity of the asset, expenditure which improve the efficiency of the assets, improve the economy of the operation and increase the productivity of the assets. Then cost of the extension to the existing assets, investment in shares, debentures, immovable properties, cost of the acquiring intangible assets, that's called goodwill, patents, copyrights, sole selling rights, license, trademark, know-how, etc. And last example means the cost of acquisition and development of the vesting assets like as mines, oil wells, tea estate, etc. Then we see here capital receipts. Capital receipts are those receipts which do not occur. They are of an unusual nature, not arising through the normal activities of the business. For example, amount received on the account of issue of fresh share capital, debentures, amount of loans raised, proceeds on sale of fixed assets, deposit, premium on shares and debentures, etc. We will see here the test of the capital receipts. It is arises out of the financing activity. It is refundable. It is non-recurring in nature. Capital receipts increase the fund in the current year. Capital receipts may decrease profit and fund in future, and it is disclosed as the liability in the balance sheet. Here we see the revenue, expenditure and income means the receipts. Revenue, expenditure and revenue receipt. First we see here revenue expenditure. Kohler defined revenue expenditure. It is an expenditure charged against the operation, a term used to the contrast with the capital expenditure. An expenditure which is not capital expenditure and which is incurred for the carrying the day-to-day business activities is called revenue expenditure. Such expenditure may be incurred for the maintaining the fixed assets in the state of working efficiency. The benefit of the such expenditure is for a short period, in any case not more than a year. It is not spread over the years to come. The value of the expenditure is comparatively small. It includes such items in the replacement, repairs, renewals, depreciation of fixed assets, discount raw materials, wages, salaries, power, etc. These are the charges charged to profit and loss account to ascertain the profit or loss from the business. Then we see here the test of revenue expenditure. The amount spent is relatively small but not always. The purpose is the maintain of the business or assets in usable or working conditions. The benefit of the such expenditure is executed in the short period, in any case not more than 1 year. The expenditure is of the recurring nature, means that arises again and again. Revenue expenditure is shown in profit and loss account. This expenses is relating to the business activities, means expenses of the production, expenses of the administration, expenses of the selling and distribution, and finance expenses. Expenses incurred to the earn income. Example means by the entries on loan taken for the purchase of shares, cost of tools, expired cost, etc. Expenses of the revenue nature incurred after the plant start commercial productions. Expenditure which is maintain the assets in the working condition. And lastly, research and development cost of return is known as the revenue expenditure. We see here the examples of the revenue expenditure. Machinery, cinema theater means cinema theater incurred some additional amount to the company. With the municipal regulation, here the expenditure incurred do not enhance or improve the theater's regulations. Hence, the expenditure incurred does not enhance or improve that the theater's earning capacity. Hence, the expenditure is a revenue. Then we see the revenue receipts. Revenue receipts are those items of income which are received or accrued in the ordinary courses of the business. For example, cash received on account of sales, discount received, common commission received, interest and dividend on investment, transfer fees, etc. Revenue receipts are the credited to profit and loss account, whereas the capital receipts will affect the balance sheet. Then we see here the test of the revenue receipts. Revenue receipts arises in the course of business activity. It is recurring in nature and not refundable. It is increased fund and profit of the current year and disclosed as an increase in the profit and loss account. Then we see here the examples of the revenue receipts. Receipts of the amount of the sale of goods in which the firm deals are treated as revenue receipts. Such revenue receipts will be credited to profit and loss account. Cash received from the sale of investment is a capital receipt. Thus, any money received from the conversion of the assets into cash is treated as capital receipts. Thus, the amount so received should not be credited to profit and loss account. If any amount is received from the proprietor, it should be treated as a capital receipt. It is not income, but it is liability, which will be shown in the balance sheet. If any amount is borrowed, it is treated as capital receipt and not to be treated as income. Interest or dividend received on income, rent received on the sublet premises, the receipt of the commission are treated as the revenue receipts. These are the credited to profit and loss account as a general rule. It can be stated that the money received for which the benefit is given by the firm should be treated as revenue receipt. If some small profit is made on the sale of asset, it is treated as the revenue receipt. However, if such profit is significant, then it is better to the treat is an capital profit and transfer to the capital reserve to general reserve. Then we discuss the deferred revenue expenditure. All expenditure incurred for the carrying on the normal business activity is known as the revenue expenditure. The benefit of the such expenditure is enjoyed in the year in which it is incurred. But sometimes heavy revenue expenditure may be incurred in the 1 year, but the fruits or benefit of its may arises or the accrues not in 1 year only, but the following some 2 years or more years. According to the guidance note issued by ICI, deferred revenue expenditure is that expenditure for which payment has been made or liability incurred but which is carried forward on the presumption that it will be of the benefit over the subsequent period or periods. Today, we see here the concept of capital and revenue expenditure and receipts. Thank you.